This is Kali Persall, editor of Institutional Investing in Infrastructure. And joining me is Brent Burnett, head of infrastructure and real assets at Hamilton Lane. Thank you, Brent, for being here. Can you just start with a brief introduction of yourself to kick off?
Yeah, absolutely. Callie, thanks for having me on here. As you mentioned, I'm Brent Burnett. I'm the head of infrastructure and real assets here at Hamilton Lane. So that means that I oversee all of our investment activities within infrastructure across primary fund commitments that we make, across secondary positions that we buy, and across minority direct and co-investment positions that we're in here at the firm.
Fantastic, thanks. So, with interest rates and inflation coming down, why is infrastructure still an interesting asset class that investors should be exploring?
Yeah, that's a good question. It's one we wrestle with a lot. What's the impact of both inflation and interest rates on the assets that we invest in? I think one of the reasons that infrastructure has been a standout performer in an inflationary environment is because it does tend to have strong positive correlations to inflation. And this is a function of a couple of things. Number one, these infrastructure assets typically have inflation-based escalators in their contract structure. So there's sort of direct correlation to inflation through those escalators in the contract structure. But then the second part is if you think of an infrastructure asset, these tend to be assets that are, largely made up of aggregates and steel and heavy equipment, and they're very large capital intensive projects. So as inflation and the cost of replacing those assets goes up, there's a replacement cost correlation to inflation as well. So you get kind of the direct inflation component through the contract structure, but then you also get the replacement costs, not as direct, but also having a positive correlation to inflation through that replacement cost. So I think that's one reason why infrastructure has been attractive, even in an inflationary environment. We've continued to see strong performance there. As inflation has moderated, that's not necessarily a negative for infrastructure. It just means that that inflation escalator component in the contract structure may not be as strong, but there are other ways that good assets can offset that.
Absolutely. Yeah, that makes a lot of sense. So, with modest performance in recent years, are you seeing valuations become more enticing now?
Yeah, in certain sectors, absolutely. And we tend to talk about infrastructure as though it's this kind of homogeneous asset class. We do it as well, but the reality is it's these distinct sectors, and that valuation question is really specific to the sectors that we're looking at, right? And I would say there are two sectors that over the last few years have gotten a little bit frothy in their valuations, and that's been on the data communication side and the renewable energy side. If you look at kind of long-term multiples for those types of assets, the data telecom assets on a long-term basis have typically been in that kind of 16 to 18 times multiple range. And it was not uncommon, and it's still not uncommon in certain growthier platforms to see those in the low to mid 20s on a multiple basis. We've seen a lot of value paid for projects that are pretty early stage in their development. So renewables are another asset type that has typically been in that kind of 14 to 16 times range, but we've seen platforms trading in the low 20s on the renewable side as well. So those are the two subsectors that I'd say had very elevated valuations. Over the last 18 months or so, we've seen those come down to, the kind of 16 to 18 times range. So those are feeling better to us today from a valuation entry point perspective. Now, not all of those valuations are created equal, right? Sometimes you're coming into a platform that on the surface looks like it has a high valuation, but you have very good visibility into that valuation buying down quickly through a pre-contracted book of business. So I don't mean to infer that valuation is always just, the metric, because there can be good reasons why you would pay an elevated valuation. But by and large, that data telecom space and that renewable energy space saw pretty elevated valuations 2 years ago, and those have corrected some to where that entry price is a little bit better. The other big sectors of infrastructure, Callie, have been pretty consistent though in their valuation. So the transportation side, historically, that's kind of a 10 to 12 times multiple business. That continues to be the case today. So, I wouldn't say valuations have been overly elevated there. Um, I would say where we've seen some deep value has been in the more traditional sectors of infrastructure. So, midstream and traditional power generation. Those are areas that have historically been in that 10 to 12 times multiple range where we've seen high quality assets with good cash yields trading in that kind of 6 to 8 times multiple range. So, those are a couple of kind of deeper value sectors where we're finding some good cash yielding opportunities. And then the last sector that we continue to focus on is in the kind of waste management environmental space. And those can be 8 to 12 times. There's a little bit more variability in that multiple because the scale of those businesses can really drive the multiple that they can attract. But it's been an attractive place to find smaller opportunities at lower valuations that can then be aggregated and attract a valuation or multiple arbitrage by scaling those platforms. So I know that's a long answer to say there are a lot of nuances to how we look at valuations. Some of these sectors, I think, were a little overvalued, have gotten better. Some of them have been very consistent with their long-term norms. And then there's a couple where we've seen some pretty good deep value opportunities.